Hello, everyone. Welcome to today's Blockworks Roundtable. TradFi is ready to embrace crypto. During the roundtable, please submit your questions to our speakers through the Q&A function at the bottom of your screen. And we'll save time at the end of the discussion to answer these. The session will be available on demand, and all registrants will receive an email once the recording is live. Today's roundtable is sponsored by TRM Labs. The views of the moderator and panelists are not associated with the organizations that they represent, nor should anything from today's discussion be construed or taken as investment or financial advice. And with that, I'd now like to introduce our panelists. So they could please turn their cameras on, microphones on. Great. Awesome. And so I would just like, before we start, we have a lot of topics to dive into today. If each of you could just briefly introduce yourselves and what you're focused on right now at your companies, and then we'll dive in. Maybe Isabella, would you like to start?
Hi, everyone. It's great to be here. My name's Isabella Chase. I'm the head of policy for the EMEA region at TRM Labs. TRM is a blockchain intelligence company that helps both the public but also the private sector fight fraud and financial crime in crypto assets. So a big focus for us at the moment is really working with big financial institutions and thinking through how we can get them on chain in a compliant and secure way.
Great. And Wakar?
Hi all, really great to be here with you guys, and thanks for the invitation to the roundtable. My name is Wakar Chowdhury. I head up the digital assets product for Standard Chartered's financing and security services at a group level. I'm based in London. Really good to be here with you guys.
Great, and Robbie Mitchnick, I'm the head of digital assets at BlackRock.
Awesome. Yeah, so today's panel will be kind of about how financial institutions are navigating on-chain adoption, the blockchain analytics that are kind of reshaping institutional risk management. We'll get into tokenization, stablecoins, all that. But first, just kind of want to start with a little basis of TradFi's movement to on-chain adoption. Was wondering maybe Robbie, if you could kind of just talk a little bit about financial institutions' efforts on private blockchains in the past, and maybe sort of the shift to public blockchains, the regulatory political temperature that has kind of been changing in recent years to kind of lead to that.
Yeah, well, I think the verdict is in on the private blockchains, and it's not good. That was obviously where a lot of the TradFi exploration in this space occurred in the early years. In particular, that was really all the banks and some of the other TradFi institutions had comfort with. But the track record is what it is, and it reflects the fact that there's been very, very de minimis actual adoption in an economic, commercial way at scale of any of these private blockchain projects. And I think, in hindsight, at least, that makes sense in terms of the curbing of the value prop of blockchain's potential that a private blockchain represents. And so public blockchains are increasingly the focus, even for TradFi firms, maybe not at all yet, but certainly that's the direction of travel. And we've seen obviously encouraging regulatory guidance over the last couple of weeks that help support the notion that this is now suitable territory for even banks in the US to engage in.
Awesome. Yeah, and I know there has been kind of this evolution over the last months and even couple of years prior to the administration change this year. So it would be kind of curious of just the broader evolution you're seeing, and maybe Wakar, you could jump in here too, of how institutions have gotten more comfortable venturing onto public blockchains.
Okay, so public blockchains, as a bank, I mean, we've taken a stance that we believe that digital assets in their entirety are going to be there for the foreseeable future, if not permanent part of the fabric of financial services. So Obviously, public blockchains are something that have been burgeoning, and that's where the volume is and activity is. And as correctly pointed out by Robbie earlier, that the majority of the activity has been in public blockchains, and private blockchains have not seen the successes we were hoping for about 6-7 years ago. For us, the main driver has always been commercial activity. So if there's client demand, we perform our duty to perform the services and offer the products that the clients need. And the need of the hour over the past 1.5 to 2 years has been a regulated GSIB or a global systemically important bank to step in and provide crypto custody for a start, and then other digital asset services that are on public blockchain. So from Standard Chartered Bank's point of view, the amount of work that's gone into enabling a public blockchain infrastructure with our partners and our vendors has been immense from a risk point of view, technology point of view, assurance and governance point of view. And I think that's going to be the same across all organizations, much like what BlackRock may have done, or other banking financial institutions and other asset managers have gone through when adopting public blockchains.
Great, yeah, and we'll jump into some tokenization stuff and regulatory stuff. But Isabella, I wanted to kind of bring you in here. First, would kind of be curious of your take from where you sit on institutions coming on chain, and then we could kind of get into a little bit of how blockchain analytics are advancing risk management.
Sure. Yeah, I mean, I would agree with both Robbie and Waqar. I think, especially from an institutional and a GSIB perspective, the importance of getting risk teams comfortable with public blockchain has been really important. And so we've seen a real transformation in compliance departments in their level of comfort and confidence with dealing with this technology. And so much of that has just come from education of what's going on in the space, but then also the maturation of tools that can provide the insight needed into the risks of different blockchains, into different tokenized assets, into the counterparties that are really engaging in this space. So I think that's been really important, the actual change in attitude in risk departments, but that has very much also been bolstered by a similar level of confidence raising at regulators around the world. I think sometimes we forget regulators make as much use of the blockchain and analytics tools and the insights that we can now garner into this type of technology. And so being able, from a supervisory perspective, to work in quite a collaborative nature with financial institutions as they explore new products, which can then, as Robbie says, draw more interest into the public blockchain space, I think has also been really important, and something that has really crystallized over the last 18 months.
Oh, sorry. And Isabella, could you give us a little more insight into the relationship, when an institution comes to TRM Labs, what they're looking for, and the type of, data and analytics that you can view on chain that's really advancing tools for these institutions?
Sure. So I think it's quite different to what tools are available in traditional finance, which is both really exciting and something that needs to be leveraged for risk management. So when we think about blockchain intelligence, we really think about it a bit like a camera that can zoom in and out of what's happening on chain. So really at the most zoomed in level, blockchain analytics gives the ability for institutions to see what's happening at a single wallet address level. So that could be the address of a customer, or more commonly in the case of institutional finance, the address of a smart contract that's holding a newly tokenized asset. And it gives you that ability, as I said, to see counterparties and the services that are using that address, the flow of funds, the source of funds, all really important for risk decisions. But then equally, zooming out a little bit, we can see when you aggregate information about different wallets around entities, you begin to make risk decisions about those entities that are issuing assets on chain as well. This can be really useful for understanding the liquidity of a customer's address or tokenized fund. And really this aggregated view just gives a very robust picture of what is happening on chain. And that's really useful for financial crime perspective, but more broadly within other risk functions, thinking about things like liquidity risk and other areas as well. And then just to finish off the analogy, if you zoom all the way out, we're also having this ability to view ecosystem levels as well. So at a blockchain level or in a stablecoin environment, what are the concentrations of risk in those environments that we need to be aware of? So, for example, if we look at the Ethereum blockchain, we know it has a really high risk of sanctions, but it's super concentrated in a few, really like a handful of services. And so having those understandings of how risk materializes in different parts of blockchain-based financial services is really important to create benchmarks and then allow institutions to operate in compliant ways. So there's a lot of insights that can be garnered through blockchain intelligence.
Yeah, and just a quick follow-up there, how are institutions kind of using these new capabilities and data to kind of maybe build their own products? How might you be supporting them in that regard?
Yeah, well, I think one of the biggest requests that we get in for our sort of services is really how can we enable one of the main benefits of tokenized assets and digital finance for financial institutions, which is speed. So in a world in which you have 24/7 trading of tokenized assets, how do we get you the risk information that is required? So as things are being instantly bought and sold, you're still operating in a compliant way. So from our perspective, it's really important to have a really robust infrastructure of things like blockchain coverage so that when new assets are minted, we can get insights to institutions as quickly as possible. So a quick example of that, for example, when the Trump and Melania coins were being minted very recently, because we have very full coverage of the Solana blockchain, although those are being created in a day, we can ingest risk insights and get those out to customers as quickly as possible because we support the infrastructure. So I think really what we're being asked to do is how can we ensure that financial institutions have the insights they need to capitalize on all of those inherent benefits of operating on public chains, speed, transparency, and interoperability as quickly as possible.
Great. Yeah, I'd love to bring Robbie and Wakar back in. We talked about, you mentioned tokenized assets. We saw BlackRock last year launch its first tokenized fund, BIDL. So would love, Robbie, if you could just kind of set up how that, the partnership with Securitize, take us through that and kind of the strategy behind what you were looking to accomplish there and bringing a fund on chain.
Yeah, well, tokenization is obviously an important part of this whole space. I think it's a ways behind crypto in terms of adoption and some of the commercial resonance with our clients, obviously, at this point, but there's plenty of excitement around it and for good reason. And so, Securitize, kind of similarly to what we did in the crypto domain with Coinbase as our initial core partner, similar to what we did in the stablecoin space with Circle as our initial core partner. Securitize became that in the tokenization space, and we started, as you note, Ben, with BIDL, our stable value yield fund, which has had pretty good uptake across a fairly diverse array of clients and client types. A lot of those are crypto native today. I think that's important to recognize. If you're a crypto native firm, being able to hold cash balances in a efficient yield generating way not having to rely on banking system moving back and forth value, and then being able to get liquidity faster through stablecoin exit ramps is a pretty meaningful value proposition that's clearly resonated. What we haven't seen happen to date in really any arena of tokenization is broad-based uptake from investors and holders who have always lived in the traditional asset space and on those rails. We have not seen them really move over and choose to hold the same instrument but in a tokenized form.
And Robbie, why do you think that is, and what do you think could change that going forward?
Well, it's a huge switching cost in effect, right? Everything that a traditional investment firm has is based on our TradFi rails and infrastructure, and despite the inefficiencies and suboptimalities that exist there, to migrate to this new standard of wallets and 24/7 and being bearer instruments and the way these trade and settle, even though I think we all believe it represents a step towards the future and a more efficient, decentralized, accessible financial ecosystem. It's a big change, and you need a real impetus to make that change. And just having sort of operational efficiency and cost savings down the line that you would realize is not necessarily the size of that incentive that you would need to see that adoption. So I think that what we're going to need is real use cases that create that larger incentive. And I think we're starting to get that a little bit from these tokenized yield funds, where if you think about, for example, corporate treasurers being able to hold some of their cash in a stable value tokenized yield fund, and then be able to get into a stable coin really quickly and move money around the world, whether that's shuffling liquidity between countries for a multinational corporation, or being able to make payments quickly to all parts of the world. That's a real value prop that can be realized. So that's a hook that we're optimistic we're going to start to see some traction around. And there'll be other use cases that'll have to be proven out in other asset classes that are kind of similar to that, beyond the more nebulous sort of more liquid, more transparent, more digital type value props that sometimes have been relied on.
Great. Yeah, we'll talk a little bit about the broader tokenization space, but first, Waqar, would be interested to hear your perspective on from Standard Chartered recently partnering to help an asset manager launch Asia's tokenized money market fund recently. Just kind of curious of how you're looking at tokenization right now and the main use cases.
So for us, again, I think, as I said before, it's all about commercial opportunity and live demand from clients. So we've got capabilities across the bank on traditional stuff, and then now we've got capability on the custody side from a digital asset point of view. We've got a bunch of ventures that actually add to the ecosystem that we can rely upon to provide us with various services. So for the main part, the tokenization strategy for Standard Chartered Bank, at least in the financing and security services, is around all the assets we currently support. So from our point of view, we have traditional custody on equities, and then we also do fund admin and transfer agency as well. And of course, we are a bank, so we have bank accounts, front to back services are available. So anything that goes into our TradFi space today is technically tokenizable and distributable. But the key question for us has always been, so what? If we tokenize, what are we going to do with that token? So for us, the critical aha moment was that if an asset manager comes in and says, I have the desire to distribute a token to distributors, either for institutional or retail for primary subscriptions and then redemptions. And I have live demand XYZ, and can you facilitate? That is the kind of use case we jump on, and with the China AMC or China Asset Management Company, that's exactly what was the case. And we're exploring more since 2 weeks we've launched. We've got a whole bunch of other money market funds that we're looking at. So the demand still remains in tokenized money market funds. The whole tokenized bonds story is still not gelling well in terms of commercial viability, at least at this 10 seconds. Maybe in the next few months, yes, we can connect the ecosystem much broader and get some traction on the equity side. Most of the markets we operate in are fairly efficient anyway, so there's going to be limited traction when it comes to tokenized securities from an equities point of view. So at this stage, utility is tokenized money market funds, where people want to hold on to a token that gives them yield, and also secondly use the token for collateral management purposes. So that's something that we're also exploring at the moment within the bank. Beyond that, on the beyond the security services and custody side, we have a whole bunch of things happening around our cash management products that we run. So tokenized deposits, looking at even stable coins. We've made an announcement as a bank with Animoca Brands in Hong Kong very recently, launch a stable coin, a regulated stable coin in Asia. So there is a whole slew of things happening across the bank, and the thesis that we always run is if there is a commercial opportunity for the client and in turn for the bank, that becomes priority with a real use case.
Great. Yeah, and you mentioned, how money market funds are kind of the hot topic in the tokenization space right now. How do you kind of view these as a complement to stable coins, an alternative to stable coins? How might those kind of interact with stable coins going forward?
Yeah, I genuinely think initially, so initially there was a notion that, they are, replaceable depending on the use case. But I think more and more we dig into it, it's a very complementary, because as Robbie mentioned earlier, that the money market fund being subscribed to in a stable coin and then redeemed in a stable coin is actually quite powerful from a 24/7 basis, 20 hours a day, 7 days a week. Whereas the cash sometimes can't catch up. Yes, we can do book entries across various jurisdictions on the US dollar bank account, but it needs the Fed to be open, then the correspondent banking network has to be up and running. So I genuinely think that the two are very complementary. The stablecoin ecosystem is burgeoning, as you know, and we all know. I don't think that's going to slow down anytime soon. And the proof in the pudding is that we have a venture called Zodia Markets that does an excellent job of facilitating significant amount of trade when it comes to stablecoins, right? So, and we're seeing them grow day by day. For the bank itself, we facilitate a whole lot of stablecoin ecosystems from various angles, and now we're about to start facilitating tokenized money market funds. And from a banking institution point of view, being able to connect a tokenized money market fund from a redemption and a subscription point of view with a stablecoin, and then after that, if a stablecoin is at hand and needs to be liquidated into a cash account, which the bank also operates, is an extremely powerful tool for entities to use. So we think that the interplay between tokenized money market funds being able to generate yield is quite powerful, then being able to settle for a subscription or being able to redeem at the back end of a redemption for a tokenized money market fund, and then taking that into a US dollar bank account or any other currency. That is extremely powerful and actually quite complementary, to say the least. So I don't think they are going to compete. Yes, for some use cases, yes, there may be some drop off, because we understand that a lot of people are currently using stablecoins as collateral, and that might start to sort of shift a little bit to tokenized money market funds. But then we also see the utility of a stablecoin in terms of a trading instrument as well on those venues, right? So the utility is going to get a mixed sort of portfolio view, in my opinion. I'm not saying it's a 50 50-50 or 80-20. We'll see how it develops over the next few years, but they're definitely complementary to each other.
Yeah, and Robbie and Isabel would be curious of your thoughts too on whether you see those kind of competing or being complementary in the future. Tokenized money market funds and stablecoins.
I think they're complementary. I don't think one or the other prevails and fills both functions. I think tokenized yield funds or tokenized money market funds will be the predominant cash savings vehicle, and stablecoins will retain their dominance as the payment and transaction instrument. And both are a little bit better than the other at those respective use cases, as long as you get the frictions down to an extremely low or near zero level to be able to move between them. Then you can use them in duality in a really powerful way.
Yeah, I would agree with that. I think just from our perspective, it's ensuring that there is that seamless movement between the two, which is really important. And if those happen on different chains, having that ability to get a good view of what's happening as products move across chain it will be really important.
Got it. And Robbie, maybe curious too of how you've kind of viewed the initial adoption of BUIDL. You kind of touched on it earlier, but I believe quickly kind of jumped out to $1 billion in assets under management. How big do you think a fund like that could grow, and how quickly? I'm sure being a BlackRock executive, I'm sure you're bullish on it, but just take us into kind of your expectation for that.
Yeah, well, right now the market for it, as I noted earlier, is really in digital asset native folks, right? But even from that, that's a very large potential market in terms of, in particular, the number of places that currently are holding traditional money funds or bank cash to be able to hold and generate yield in this much more convenient and useful format. That's obviously tens of billions of dollars in total TAM. And then as we think more broadly about TradFi adoption of tokenization, then this or other flavors of it become relevant for a much larger TAM that includes money funds in traditional format, of course, but also to some extent for some bank deposits, right? And particularly as more and more people migrate to the digital assets ecosystem and move on chain, that opportunity becomes quite large.
Yeah, and also you and Waqar kind of touched on the broader tokenization space growth and some of the use cases that might not have really developed yet. Just without getting into specific future products, what kind of things do you weigh when from a client demand regulatory perspective when you're looking to add tokenization products or tokenize certain assets?
So it always starts with compliance and regulation. So there are certain hurdles that us banks have to go through to get certain things approved. So I'm not going to talk about that because that's quite obvious that we have a significant amount of uplift in compliance and regulatory conversations. But one thing I would touch on regulation is that each jurisdiction treats assets differently depending on the maturity or the understanding of the tokenization capability that is offered as a custodian versus an asset manager versus a hedge fund versus a trade finance company. So there are differences of opinion, and each regulator is different. So securities regulators look at it slightly differently. A commodities regulator or somebody like CFTC will look at it slightly differently. So we have to navigate that. And given our presence in nearly 60 markets directly and indirectly in 130 countries around the world, we deal with this on a quite regular basis. So we've become quite good at it as a bank. So that is number one criteria that what we're about to do, does it tick all the boxes from a regulatory point of view, and then within compliance that we're good to go. The second leg is then commerciality from not just a of course, we're a commercial organization, and we need to realize, the commercial goals that we have for our shareholders. But the main thing we look for is that if we invest in something today, is that something that we're investing in for today, or we're looking at the next 4, 5, 10-year horizon. And by investing in something today, be it our ventures that we set up through our Standard Chartered Ventures arm, or we invest in things within the bank, we foresee things like uptake and demand as to what it is today. With the kind of regulations coming down the pipeline and the industry changes to an industry forums, things that are happening in the market that will shift the dynamics when it comes to trade, when it comes to settlement, asset servicing, etc. And then the final thing we look at is who is behind the buy side, sell side, and the intermediary legs, right? And if we pull this story together, that gives us a pretty clear idea if this is going to set the commercial benchmark that we think is appropriate for us to enter. So the next thing that we're currently looking to do is enable tokenized money market funds for a broader use case, not just for primary subscription and redemptions, but there are other things that we're looking to do with tokenized money market funds in the bank. And there's real genuine demand, as we know. We've also got some demand from a couple of institutions that want to do tokenized bonds, but the demand is unilateral. There's no other side to the demand at the moment. So we're holding fire on that one at the moment. There's other things around core infrastructures that we operate with. So if one of our CSDs is looking to go digital, then we have to follow, because we currently are providing services to our clients from an asset servicing point of view that requires us to keep up with the CSDs. So when a CSD does say, look, we're going to go digital now, the bank has to move in lockstep with them. So we don't see a huge shift in equities, as I said, but money market funds, there are definitely very clear commercial and operational use cases coming through. There are some bond use cases that are coming through, but not to the extent that we're seeing on the money market funds. And hopefully, with the advent of digital CSDs in the next few years, we see a lot more adoption when it comes to T+0, truly with the help of either a money market fund on the other side as a settlement instrument potentially, or a stable coin. And that is something that we're dealing with today, and hopefully in the next year or two becomes clear as a strategy from Standard Chartered as we explore more and more use cases and we start announcing them. There'll be a few in the next few weeks we'll be announcing as well. So it's a slow move, but we're being very considerate in terms of which ones go live first, and based on the 3 main criteria I just explained to you.
Yeah, and Robbie, your perspective from BlackRock, would just be curious of how you kind of see when you're thinking of developing new products in the tokenized space, without getting too specific, just kind of the main things you're looking at and how you see that.
Yeah, I think Wakar's framework is great and right on. I think that's part of what's enabled Standard Chartered to be such a leader in this space amongst the large global banks. They've done an amazing job, being out in front of this. You have to get beyond sort of fluffy value prop, future focused transformation thinking, and really dig deep into what are the problems that it solves. Because even if everyone agrees that the future of financial infrastructure is tokenized, that's not good enough to actually generate near-term adoption that helps get us from here to there, right? So finding the products that will have real product market fit, and where tokenization actually solves something that traditional infrastructure can't do, that's the breakthrough. So far, the industry's really only found one of those, which is in these stable value yield funds and using them in concert with stable coins. There will be others, but that's kind of where we are as a baseline right now.
Great. Yeah, and I'd love to get into broader crypto market dynamics in a bit, but just because we talked a little bit about regulation. Isabella, I was wondering, what might be something you're watching for on the regulation front, particularly under this new administration, that could kind of spur some unlocks as it pertains to institutional on-chain adoption?
Yeah, so I think everyone is really watching the stablecoin space in terms of what is actually going to happen with legislation there. So obviously we have the Genius Act bill already, which will legislate for stablecoins for payment. I think, when you look at the details of it, creating permitted issuers, reserve requirements and general governance and reporting requirements, that is not massively different from other stablecoin regimes that we see around the world. But of course, when you have a formal framework in the US, it will put other pressures on other markets, which will be really interesting. I think something as I sit in Europe, I really keep an eye out on is when especially European regulators, but we also see this in the Middle East, were developing their own stablecoin frameworks. One of the key motivations for those was protecting monetary sovereignty from US-backed stablecoins, US dollar-backed stablecoins. And of course, that is a problem that US legislators will not have to solve for. And so ultimately, what that means for the framework is probably that it will be less burdensome than European, or I think the VARA framework is pretty workable. So in creating a system with less burden, does it make it even more attractive? And you already have so much liquidity and a great domestic market in the US. So what does that mean for other stablecoins, but also the development of other assets like CBDCs for the rest of the world? I mean, we saw just this morning Christine Lagarde of the ECB say that in the changing face of US appetites towards digital assets, the EU is going to have to accelerate its work on the digital euro for both wholesale and retail payments, because this has now become much more of an urgent need. And she's released a 86-page report on what the digital payments and asset space will look like in Europe. So I think for people sitting outside of the US, the ripple effects of this administration for how other jurisdictions are thinking about maintaining a sense of competition and competitiveness in how they either issue assets, allow assets, or support financial institutions who are trying to experiment with moving on chain, is really a big focus for myself at the moment.
And I imagine too, Isabella, on mixers too, maybe some clarity there, and how that pertains to better forms of on-chain privacy. Be curious of what you might be looking for there.
Yeah, totally. So under the last administration, the treatment of mixers, but at its core, like how do you secure this issue of I need to transact privately on chain? And as we have more adoption, both in the retail and in the institutional space, being able to protect privacy of transactions is going to be really, really important. We haven't seen a huge amount out of this administration other than the ongoing rulings on Tornado Cash. Under the last administration, there was a notice for proposed rulemaking on mixers that would have been incredibly burdensome. Ultimately, I don't think they're the solution to privacy on chain. There will definitely be a technology solution, which is likely to be based on something like ZK proofs or verified identity credentials. It's just we are yet to see a huge amount of momentum in that space, and crucially adoption as well. I think blockchain analytics has a really considerable role to play in bolstering these solutions and assisting them and really bringing them to the market so that we can have that ideal future where you can transact securely, privately, in a compliant fashion at scale on public blockchains.
Yeah, and then Robbie and Wakar, just any regulatory unlocks that you're looking for that could potentially kind of impact the trajectory of what BlackRock and Standard Chartered are going to be able to offer going forward.
Well,
I'll let Robbie go first, I guess. Yes.
The stablecoin bill in some form will be great progress. The digital asset market structure legislation process in some form will be great progress, and then the enablement of banks to partake in activities in the space that historically they either very clearly haven't been able to, or sort of implicitly haven't really been able to. Clarifying that and giving them the ability to provide the kinds of services that other crypto native firms are already doing, I think is great progress.
Okay, so for us, there's a few, right? Given we're now in practice mode, real practitioners in providing custody. The two main areas that we would love for things to start getting cleared up is the treatment of digital assets on the operational risk frameworks on the books of banks from the BIS level, so BCBS D545. So the actual implementation of D545 and what that means in terms of the risk add-ons, the use of public blockchains, the aspect of Group 1, Group 2 assets, how it actually really happens on the ground with the likes of the PRA of Bank of England and the wider prudential regulators. And that clarity in unison and in uniformity across the globe will be a massive unlock for banks to enter into this space, provided that these things are, the actual implementation of those is not prohibitive, but permissive. Number one. Number two, it's a more nuanced aspect of dealing with crypto as a bank, and TRM Labs are quite well aware, maybe BlackRock are also quite well aware, is the implementation of the travel rule and the lack of clarity in the industry in terms of being able to transport information across boundaries and corporate layers is a significant challenge to scale. Yes, on a smaller scale as the industry is at today in crypto, it's manageable through certain processes. But to go to true scale where we have millions upon millions of transactions happening, that's not feasible with the current setup when it comes to the travel rule implementation. So maybe a global sort of college that should be formed across all the AML regulators around the actual implementation of this in the absence of a common standard. That will help. And these two things, I think, for banking institutions are a huge unlock to facilitate wholesale activity for institutions.
Great. And obviously because we have the head of digital assets for BlackRock, would love to touch on the largest Bitcoin ETF, which launched last year, IBIT. And maybe Robbie, if you could just kind of chat a little bit about who's buying IBIT right now. We've seen Bitcoin's price dip quite considerably from its all-time high in January. Some recent developments of a strategic Bitcoin reserve and Cynthia Lummis reintroducing a bill for the U.S. to start buying Bitcoin. So with all that kind of, what are your conversations like as you're talking with people who are mulling an entrance into Bitcoin exposure?
Yeah, so early days, it was a lot of end investors buying, direct in brokerage accounts or, through their private bank, but on their direction, not the advisors. Advisors were generally not permitted out of the gate to recommend this or put it in client portfolios. What we've seen is a shift over the last couple of months in particular. You've seen more wealth advisory platforms approve this for their advisors. There's a bunch in the pipeline that'll become publicly known soon. And I think you just continue to see the natural progression of that as these firms complete their due diligence processes and get comfortable. And then there's the institutional part, right? And that is definitely growing. I think that what's happened is there's been confusion in the market, confusion in the narrative around, Bitcoin fundamentally looks like a digital gold-like asset. It's global, scarce, decentralized, not tied to any one country or economic or political system. It's a pretty appealing set of properties in 2025 in the world. But then some days it doesn't trade like that, right? And so we have a lot of institutional clients who say, how do I reconcile those two? It seems like it should be this, but tariffs got announced and it went down, and like equities, and that's confusing to me because I don't understand why tariffs impact this. And the answer is they don't. But the market sort of has pre-programmed this idea that you should trade Bitcoin like a risk-on asset, despite the fact that doesn't make any sense based on fundamentals. And so that can become, at least in the short term, somewhat reflexive and self-fulfilling.
Yeah, and how do you see that misconception potentially clearing up? I mean, we hear a lot of big asset managers like BlackRock and Franklin Templeton, Fidelity talk about the need for further education
Yeah,
in this asset class. But
totally. I mean, yeah, education is a huge part of it, and so we've played a very active role in doing that with our clients, and we'll obviously continue to do that. I think that when you see more episodes where short term it looks a certain way, that seems counter logical, but then medium term and long term it behaves more like you'd expect, which is consistent with its history. Then people start to train themselves to ignore that short term noise, which is more driven by like levered speculators and hot money traders, and not really thoughtful long term buy and hold investors. So take August of this past year, for example. Bitcoin, took an absolute nosedive over the course of about 36 hours. There was no fundamental basis for that had to do with, Japanese yen carry trade unwinding, like very disconnected from Bitcoin. Yet Bitcoin was on sale, and some people sold it in that because they were programmed to do that, and they obviously felt silly pretty quickly after, because Bitcoin recovered its level and then went on to double over the ensuing 4 months. So you get more episodes like that, and people realize that you shouldn't react to economic news that actually has no fundamental connection to Bitcoin. It just takes a while for some of the dust to settle and the narrative to get sorted out.
yeah, and Isabella and Wakar, curious of your thoughts of that potential misconception, the investment thesis of crypto, and what might be holding some people back from jumping in.
Okay, so yeah, I mean, crypto for us is genuinely an asset class we think is not all cryptocurrencies. There's a limited set of cryptocurrencies we think are long-term play. Hence, we are now in this market servicing our clients. The misconceptions actually, I'm not going to talk about the traded portfolio misconceptions. I'm going to talk about the misconceptions around the risks of crypto, right? So what if the value goes down by 20% in a day? As a bank, we see assets that actually are far more volatile than that at times, and not all the time, but at times. So as a bank, we know what the boundaries are when it comes to interacting with assets like that. The key example of that is, as a custodian, the value of the asset is immaterial to the operation of a custodian. So, that's the safest way to enter into this market to service. But then when you start to add on more services from a banking point of view, which, all the banks probably will be looking into, is potentially providing liquidity at the back of the holdings at the custody on the custody account, then rehypothecating the assets. The risk of or double-tailed risk, if you want to call it that, of a highly volatile asset needs to be managed quite proactively and prudently. And that's where those risks are quite evident over the past few years. So that's not going to go away. Unfortunately, that the risk is there, and that's just the way the asset behaves. And that's where some of that high risk basket in a portfolio of 100% to 3% to 5%, that I don't see crypto moving out of that anytime soon. That is spot crypto, but ETPs, ETNs with certain notes, etc., attached to them, they could be a little bit better. Now, when it comes to hacking risks and the theft risk, etc., we have to consider it, of course, from an operational technological point of view, but also from a money laundering point of view as well. And that's where the tools that we use in regulated financial institutions, which includes tools like TRM Labs, is something that is at the forefront of protection for us and for our clients to keep our wallets as clean as possible. And not get assets that we don't like, or work with entities or onboard entities that are not savory based on the reports we get from our vendors. So it's a multifaceted risk for us to manage when it comes to interacting with crypto. But it certainly is something that we're able to manage at this stage with a limited number of cryptocurrencies we can work with, not all thousands of them, but for now, Bitcoin and ETH does it for us, and then we hope to add another 4 or 5 more into the arsenal going forward.
Yeah, and just to double down on that hack point, I think, for so long, something that put people off from investing in this space was that it's all a scam and, everything gets hacked. And sometimes it feels like that narrative, it felt like it was getting very old, it was very stale. And then we have the crazy meme coin period from earlier this year, and now the largest hack of all time, 1.5 billion out of Bybit. And so then, we are reminded again that those operational risks and the financial crime risks are actually very present. I think it will be really interesting to see the impact of regulation on helping to support financial institutions in preventing these risks. So, for example, in the EU, we now have DORA, the Digital Operational Resilience Act, which provides a framework to financial institutions from cybersecurity. Now, that will go nowhere in terms of impacting threat actors who are clearly highly motivated and highly proficient in executing these types of attacks. And it is unfortunately just a characteristic of this ecosystem that being online, it will be attacked. But I also think that a lot of people have been hearts have been warmed over the last 2 weeks following Bybit, seeing the community response. TRM will be making an announcement in a few weeks about an initiative that we've been working on. There's a real sense of camaraderie in how can we, if we all want to reap the benefits of this technology in these ecosystems, what is the role we're all going to have to play in being really proactive about supporting it? So as the narrative around hacks, scams continues to evolve, and it will always be present, it's nice to see the industry coming back and trying to find solutions.
Yeah, and Robbie, as we were talking about IBIT, just one more question on that before we get to a couple Q&A. We saw BlackRock recently talk about a 1 to 2% allocation for IBIT, and made those allocations in some of its alternatives-focused model portfolios. Curious if you could just talk a little bit about the reaction that BlackRock saw to that decision, and how that might be a signal for potential allocations in other model portfolios going forward.
Yeah, I mean, their action's been positive. Frankly, hasn't been that pronounced, because it's sort of the logical progression of the way we've been talking about this as a firm for many months, whether that's in research-focused publications, whether that's in Larry's public appearances, and in mine and Samara Cohen's and others' public appearances. So it's all consistent with that, and it's gone over well, and we'll see in terms of the expansion to other models as